And what a wealth creator this is.
Everyone's expression is.
No, this is Aisha's expression is the expression of a lot of investors who have not bought Shree Cements. Did you buy it?
Yes.
Why did you sell it early?
I have not sold it yet.
Awesome.
And that is because, I happen to be
So
from...
don't judge by just expressions. His expression doesn't give you anything.
Why aren't you selling it? It's the most expensive cement stock in the world.
Nikunj, the way it works is that even today, it is still giving you a 1400 kind of a EBITDA per ton, which even the largest scale player, which is UltraTech, it is not matched up there, despite the fact that they've got cost synergies going from the Century acquisitions as well as the Jaypee integration. And that's the reason why Shree gets a EV/EBITDA multiple of close to about 18 times against a sector average of about 8-9. So I think very clearly the market is looking at that this is a growth stock that can compound earnings at say 20-25 times, 20-25% over the next 3 years. And as Mr. Bangur himself said that, he will have sufficient cash, he will have sufficient margin, even at the end of year 6 once he becomes 80 million tons. So you've got size as well as profitability. I think, that's what the market likes.
Okay. So just stay invested.
Yeah, I think...
Ignore valuations. It is the most expensive cement stock in the world. It is a cement company which is commanding P multiple of a consumer company. Cement is cement, bhai.
I completely agree, Nikunj. But right now, I think one has to look at what is happening across the market. What is happening is that you are valuing profits and their certainty. And because today, no other asset class is giving you reasonable, inflation beating returns, that's why such companies become franchises of their own, and hence they keep getting, valued at that prices. I mean, the staples, or for that matter, stock that we've often discussed is Trend, or even for that matter, DMart. I think these are companies where the investor belief that 25-30% earnings CAGR will be delivered. I think that's fairly high. So that's where you start looking at a PE to G kind of a multiple. And there, I think, in market cycles, you will have overvaluation phases. But then over a period of time, these stocks will never come back to the classical tenets of value investing.
Look at the difference, okay? Shree Cement in the last 10 years is up 50x. During the same time, ACC, Ambuja, now owned by Lafarge, they've become size, they have reach, they have a global parentage. The stocks have doubled. You've not managed to even beat the index if you bought into the India housing stroke infrastructure stroke the cement story. The one outlier here should be Dalmia Cements, I would imagine, and then let's look at UltraTech, because UltraTech has become large now. So let's see where UltraTech stands, but UltraTech is up 10x. Dalmia Bharat, no, that's the sugar company. Dalmia Cement is the one which we should look at. UltraTech is up 10x. So if I do a like-to-like comparison, large cement companies have disappointed. Niche cement companies, in a sense, have really managed to surprise everyone.
In fact, the same logic works here as well, because even Dalmia, the EBITDA per ton is consistently high. Even Dalmia will give you a 1200 rupees kind of EBITDA per ton. So profitability is what people are valuing, because the sector basis right now growth is not visible. You're down to 5-6% kind of a volume growth. But yes, market is looking at it as a transient mode that maybe as the growth picks up, the volumes growth will also come back. But right now, what is getting valued is clearly the EBITDA per ton and the sustainability.
India Cements, they also have a great EBITDA per ton. How come it's not getting valued?
I think South is then that's where you come to the other problems of, the CSK angle, the other things. So I think as far as Shree Cement goes, it was a pure cement play. You always had a very good, fuel and cost kind of a control on their fuel cost, which is a large part in the cement mover. And they continue to maintain organic growth. If you look at Shree has not done any, great inorganic acquisition. They've always grown organically. So today they have become player of size. They're giving profitability per ton, and the fact that growth is, in their markets, realizations are good and holding up. So I think that's where the stock will trend. I think, yes, I agree with you at $12 billion of market cap, it is definitely overvalued, but chances are, will it remain so? Yes, if the profitability, visibility to the investors is high, of course the stock can remain at these values.
Okay, that's that on cement.
That's Aurobindo that continues to be in focus. So let's get a take from you, Sameer, on Aurobindo. This one seems to be defying all odds otherwise.
Well, Abha, in fact, exactly as Pankaj mentioned, I think this was one big overhang because Unit 4 was very critical. And, apart from all the building blocks that they had built over the last couple of years, suddenly when the unit came under FDA cloud, well, Nikunj, the stock had corrected a fair bit. So today, if you look at, see, it's going at about an EV/EBITDA of about 9. So for a company where the approvals are already there, The delay in approvals was because there was an overhang on that, on the unit, and with the EAI status being granted, as Pankaj rightly mentioned, it is normally assumed that the it will be cleared it's a matter of time. So if that happens, then I think the growth visibility again comes back into play, because I think the market had corrected the stock a fair bit once the FDA the restriction came into the news. But I think after this, it's a tremendously positive news item for the simple reason that now the growth visibility that the stock was earlier being looked at into 2021 and 22, that comes back into very clear on the table. So I think that's where the valuations will probably, and anyway the discount to the sector average was existing a fair bit. So that will get corrected.
Let's look at the 6-month chart of Aurobindo Pharma, and it's just seen a vertical fall. It was at 600 plus, from 600 came crunching down to 400 rupees. In last 6 months, I go 630. 630 came down to sub 400. Sub 400 has gone back to 550. Now, when the fall happened, and I think it's open information that some of the ultra HNI investors and some of the famous heroes of Indian stock market, they have exposure to Aurobindo Pharma. It includes of Rakesh Junwala, HDFC Mutual Fund has a 7% ownership there. The challenge with Aurobindo Pharma has been that they have a debt on the balance sheet, and the Sandoz acquisition, which was supposed to have got completed last year, did not go anywhere. And on top of that, they got this entire unit for yes and no. Now, it's one of those stocks, Sameer, where frankly you could say sasta hai, but it's not made money. And this is despite the endorsement coming from the ultimate heroes and the big cowboys and the ultimate stars.
Well, Nico, if the stars invest in a stock, that doesn't mean the stock will not be exposed to the vagaries of the cycle or the regulator. I think that is not a given. But having said that, I think you are looking at it maybe over the last 12 to 24 months. But I think if you take it the time frame in a slightly stretched horizon, Aurobindo has done fairly well for investors. And even today, I think at a 10 times forward multiple, in case the growth is back into question, then the stock definitely has an upside even from these levels. So I think in a market where you're not seeing growth available otherwise, if you're seeing a stock where growth certainty is now becoming more evident and valuations are comfortable, I think the investors would be probably better positioned towards looking at it more amenably.
Okay. We've been talking about as to how PSUs have underperformed and they're at multi-decade lows. Any PSU you would want to bet on?
Well, Aisha, I think there are a lot of businesses which look good at this value. Say a BEL, I think because the last quarter was not slightly up to expectations, therefore the stock has corrected a fair bit. There is always a ETF overhang. But I think at that valuation, the business looks good. I think the way we are looking at the coal auctions, the iron ore auctions, I think NMDC is definitely value. But the larger context is the whole PSU flavor would be in relation to how do investors perceive that the divestment target would actually be met in the current fisc. Because I think the way it works is that today with the entire coronavirus scare, the supply chains getting reworked, and the fact that global growth might come off, I think the silver lining also is that today the inventories in the system have got completely cleaned out. So today, in case the coronavirus issue is contained, and we know that yes, the worst of the contagion has been arrested, I think from there onwards the revival will tend to get very sharp because the inventories are clean, you'll suddenly see restocking, all those things are likely to happen. So I think that's something the market is willing to work with and look forward, and hence the current bad news is being looked at as a transient way. But I think if that happens, and we hope that the government will ensure that the Jan-Feb-March quarter they continue to spend, because if they don't, then the fiscal will again come into stress, and the growth that we have seen in January green shoots would then again tend to get belied.